Interest rates, yes, they have been all over the media pretty much all year. They're the talk of cocktail parties, backyard barbecues, fire pits, whatever else. And everybody loves to boast, hey, I've got that 3.5% mortgage rate, but I can't move. I'm never going to move. Well, are you the person sitting there in your home browsing real estate listings thinking, wow, I'd love to move to that great golf course community? Or even worse, is your significant other texting you listings from Zillow saying, hey, honey, we should go look at this house. And all you can think about is your 3.5% mortgage and it doesn't make sense to move. Well, this week's total cost analysis is a quick look at a 3.5% mortgage versus buying today when, yes, rates have hit over 7% again. But what I'm here to show you now is that it is not all bad news, and it can and does make sense to move up, situation permitting. When we look at the total cost analysis, what we're doing is looking at a homeowner with a house that's worth $700,000. And what I'm using for an example is a $600,000 purchase back in 2020 with a 5% down payment, current mortgage balance $547, interest rate 3.5%, payment $3,700. Well, what if we wanted to move up to $1 million house, say with a 10% down payment? We take our equity from the home we live in, move up to $1 million house. Yes, rate's going to be higher. Payments no doubt going to be higher. No question of that. Cash to close, you're moving money. You're moving equity from your current home to the new home. Well, what if you did the move up and kept your current home at the 3.5 rate and moved up to the $1 million house? Yes, you're moving money again, or you're spending money, I should say. You're going to have a higher payment. You're going to have a higher interest rate. But let's look at net worth. And this is something that people rarely think about, and it's also hard to compute. But assuming a 7% property appreciation rate, which is low for the area, it's low historically even for the last 20, 30 years, net worth in 15 years, if you stayed in your current home, you would have $770,000 in equity. Not bad. If you moved up to the new house, yes, you have a higher payment, but you're accumulating more equity, $878,000 in equity. Well, what if you moved up and rented out your current house? Now you've got combined equity from both properties, looking at over $1.6 million in equity. And yes, that is assuming today's interest rates. This is not taking into any assumptions or any thought of the potential to refinance, which we all know will happen at some point. We don't know if it's going to be in 6 months, a year, or 2 years, but that will only give the opportunity to increase equity even more. In the total cost analysis, when you click on the more info button, you get a quick snapshot, 15 years, home value with appreciation, loan balances, total mortgage paid, and down at the bottom, total net worth. Do you want to stay at a 770 net worth after 15 years equity, or go to 878, or how about go all the way up to $1.6 million? If you'd like a total cost analysis with any sort of scenario, speculating, or I shouldn't say speculating, looking at a move up potential, comparing it to your current mortgage, comparing it to current rates, comparing it to future potential rates, future equity, please don't hesitate to reach out.